economies have been at the forefront of global growth, driving innovation, trade, and investment. A growing middle class, increasing urbanization, and a focus on sustainable development are opening up new opportunities in Asia. Let us hear what our panelists think about the Asia outlook and opportunities in our next panel. Let us welcome our moderator, Bonnie Chan, from the Hong Kong Stock Exchange, and panelists, George Elhedery from Haijiao from the Bank of China, Professor Yiping from Peking University, and Bill Winters from Standard Chartered. This session will be partially conducted in Putonghua. Thank you, Bonnie. Over to you.
So it's past noon, so good afternoon, everyone. I hope you've been having a great summit so far. It's wonderful to see a lot of familiar faces from around the world here in Hong Kong. And because Hong Kong is at the heart of Asia, this next topic discussion is going to be about the outlook and opportunities for investing in Asia. Now, just to set things in context, let me canter through some facts. So Asia is, of course, as we know, the fastest growing region in the world. It has 60% of the world population, contributes nearly half of global GDP, and 60% of GDP growth. It has 3 of the 5 largest economies in the world, 5 of the 10 largest stock markets, including, of course, Hong Kong, and represents 1/3 of the global bond market. Now, at the same time, new growth drivers are emerging. The digital economy, we heard from the last panel, a growing middle class, advancement up the value chain, and of course, amidst all these opportunities, there are also challenges that complicates business and investment decisions, such as domestic economic fluctuations, geopolitical tensions, regulatory complexities. But no fear, because we have 4 heavyweights, experts on the region's investment landscape to provide insights into the opportunities and the complexities. So without further delay, let's dive right into it. And we're going to start with George, because you are the newest kid on the block, shall we say? So let me turn to you for the first question. Asia has long been a strategic priority for your bank, HSBC. What's your current perspective on the Asian market, and where do you see risk and opportunities?
Thank you very much, Bonnie, and thank you, everyone. So we start with the heart of Asia, and from Hong Kong, and let's talk a little bit about China first. Again, at the heart of Asia, China 40 years ago, GDP was $250 per capita. It's $12,500 per capita today. In 40 years, the GDP is multiplied by 50 times. If you look at what China's achieved over that journey, over the last now 10 to 15 years, China's been the largest manufacturing hub in the world. China's been the largest exporter for more than a decade in the world. And China wealth has grown one of the fastest in the world. And if you look at Hong Kong, where we are here, Hong Kong's capturing more than 20% of the share of wealth creation movement offshore. And by leading consulting house, notwithstanding we're the Hong Kong bank, so I'll be talking my book here, but by one of the largest consulting houses, Hong Kong will be the largest offshore center by 2028, with about $3.2 trillion of managed funds for wealth, ahead of Switzerland with about 3.1 billion. So that tells you the journey that China's gone into and the outlook that it can provide. Now, starting 2017, tariffs have started to weigh on some of the economies, specifically on China. Then COVID, and then we went into a world frenzy of supply chain diversification, supply chain resilience, reshoring, and granted, some re-onshoring has taken place. But the reality, really, what has taken hold is the China plus one strategy by many of the global producers, supply chain, global corporates. The China plus one strategy meant we wanted to find alternatives to create resilience and to create de-risking of the supply chains with heavy dependence on China. Well, it turns out that the +1 has, in most of the cases, been here in Asia. The +1 has been the Vietnams, the Indonesias, the Thailand, the Malaysias, the Singapore, the Indias. The +1, granted, has been Mexico, but my Mexican colleagues remind me they're part of Asia Pacific. So there is a lot of benefit that this region has captured from the +1. Now, more interestingly, a lot of the +1 has been a China-driven +1. So China's been asked and tasked to build the +1. So when you look at the FDIs from China into ASEAN, we're now at about 50%, displacing inbound investment into, or FDIs into ASEAN from the US, from Korea, from Japan. China's become the largest. If you look at trade patterns, ASEAN has become the largest trading partner for China, ahead of Europe and ahead of the United States, with about 14% of the Chinese exports. But also, interestingly, about 30% of ASEAN exports is back into China. So there's a material benefit, or material virtuous circle that's been created in Asia with this +1, China +1 opportunity. If you look at trade patterns and trade flows between now and 2020 and 2030, we're talking about 5 years actually, we're expecting those flows, intra-Asia flows, to increase by another 65%. Now, this is massive considering they're already larger than many of the flows going across the Pacific. So it does give us a sense of the value of the opportunity here. I mean, we at HSBC, we have 60% of our 210,000 staff based in Asia. We have about 30,000 people here in Hong Kong, 30,000 people in mainland China, 45,000 people in India, 20,000 people in ASEAN, another 10,000 people in Middle East, if we look at this as the extension. But if I turn to the challenges, there are many challenges the region is facing. There are many challenges that China's been facing, which we talked about. I'm not going to dwell on, but structurally the strength is there. Cyclically, the challenges have to be overcome. There are also challenges that we haven't talked about, and I'll call one out. This is a highly dollar-dependent region and a high dollar rate dependent region. In other words, high dollar rates for economies with floating currencies is putting pressure on the currency. And the moment you put pressure on the currency, you put pressure on foreign direct investment and other financial investment. And then for those currencies that are either pegged or managed, high dollar rates means high funding cost and basically a break somewhat on the economy. And that's really particularly the case of Hong Kong dollar, that's faced with a very high rate environment due to the peg, but with a slower economic backdrop, and that obviously exacerbates the cyclical pattern that we're facing. Thank you.
Well, thank you for that. I do like the fact that we're starting the discussion about outlook and opportunities in Asia by talking about China first. But as we know, Asia is a very diverse region with developed high-income economies alongside a lot of emerging players in the ASEAN. So let me turn to Bill. As one of the largest international banks in Southeast Asia, what opportunities do you see in the region? And would you say that ASEAN is now a key driver of the overall Asian growth narrative?
Yeah, thanks, Mani, and of course, thanks, Eddie, and everybody for having us. I completely subscribe to George's views about the importance of ASEAN in its own right, but then vis-a-vis China. So, not to repeat what George has said, but the China +1 is largely going into ASEAN, and the trade flows are increasingly important. So, as one of the few largest trade banks in the world, our largest trade corridor is China-ASEAN, and it will continue to grow quite quickly. The opportunities from here, I think, are the greater unification of ASEAN itself. ASEAN, it is a trade pact, but it's nothing like a free trade zone. So the intra-ASEAN flows, either through Singapore or between these countries, are still a fraction of what they could be if ASEAN were to continue its process of political reform and unification. But Bonnie, as you say, it's quite a diverse region as well, with some of the wealthiest countries in the world, and as well as some lower middle income countries and growing. So I think the opportunities in ASEAN are huge. the region as a whole has tremendous access to some of the future minerals that will be critical. We're seeing in Indonesia. A big chunk of the EV supply chain is coming out of Indonesia today, and Indonesia, I think, has been quite clever about the way that they've effectively forced a vertical integration into Indonesia. So it starts with mining nickel and lithium, and soon you're producing batteries, and soon you're producing the electronics that support the battery production. This has been a real driver of economic growth in the region, and I think each country in ASEAN has that angle, or at least certainly the ones who have been most active, thinking Vietnam and Malaysia. And then there's Singapore, which I know that Singapore and Hong Kong love to pretend not to compete with each other. All I know is competition is good because it makes everybody better. We're completely agnostic, I can tell you. I'll say the same thing in Singapore on Friday. We're completely agnostic about this competition. We want Hong Kong and Singapore to thrive. And I must say, and I know George is in the same position, but having a big presence in Hong Kong and Singapore, actually the amount of cooperation between these countries in terms of the core values of promoting trade, investment in Asia, being, say, responsible participants in the global economy and in global markets, setting wise regulation, there's more in common than there is different between Singapore and Hong Kong. And that, of course, makes me very happy because we don't ever have to criticize anybody. We can just praise all. But at the moment, we're here in Hong Kong, and man, is this place buzzing, right? I mean, for those of us that have been here for 3 years, to have come the first year as we were coming out of COVID, the second year to say, yeah, China and Hong Kong are relaunching, to come this year and feel a real buzz in the environment, that of course is reflected in all of our businesses, I think, which are doing quite well. And I wish many years to come. So thanks again, Eddie, for having us.
Well, thank you for that, Bill. And, I like your remark about, praising all. And in fact, a few weeks ago in Riyadh, we had this debate about whether the world is deglobalizing or reglobalizing, right? I'm going to go off script here. Do you think we have a chance of, doing more reglobalization if Asia work together more?
Absolutely. I mean, there's two trading unions in the world right now that are way underdeveloped. ASEAN is one, and of course that connects directly through to China, and Hong Kong is a central participant in that. The second is in Africa, not the topic today, but there's an Africa free trade zone. It's just getting started. That connection, that trade corridor between Africa and the Middle East, between Africa, South Asia, between Africa and Asia, is big and growing very fast. So to the extent that we can get the internal cohesion in these trading blocks so that the logistics make sense, so you can actually transport something from Nigeria to China via Kenya and all the countries in between without paying tariffs and logistic charges, et cetera. Now, we're a long way away, but the commitment, the political commitment is there. And of course, when you've got a buyer at the end, which in that particular example is somebody in China, they're going to do their bit to make sure that that unification happens because it's in their interest to have a sustainable supply chain with data that's cohesive, with a tax regime that's conducive. So yeah, I mean, all this globalization is dead, globalization is going backwards. Sorry, it's just simply rubbish. It's just not true. Globalization is as strong as it's ever been. It's just showing up in different places. Trade volumes are increasing. 60% tariffs coming out of some country to another country will not change the aggregate level of global trade. It will just redirect the flows. Of course there's a friction cost, and we're all going to pay for it. Of course there's a friction cost. But man, markets are so cool. They immediately re-equilibrate around the friction cost so that economies continue to thrive. So yeah, bumps in the road for sure. Globalization ain't dead and it's not going to die.
All right, we'll leave globalization as a separate topic, and you do it another day. We can talk for hours on that. But thank you for teeing me up for the next question, because as you said, it goes back all to China. So I'll turn to Professor Huang. So this morning we've heard from the leaders. Mainland authorities have announced a series of monetary and fiscal measures. And so far, I think the jury is still out because it's drawn very diverse opinions from market analysts. So how do you think these measures should be understood and assessed? And what would be the broader impact on global investors would the potential changes in US trade policies have any bearing on China and Asia? That's a very frequently asked question in the last few weeks.
Well, I don't think there is any disagreement on whether or not the macro policy actually turned. The question is, I think, whether this is enough. The market is always disappointed by the fact that the number is not big enough. I actually think that's a psychological game. My own advice, obviously, is that the government should announce a huge number, because if investor expectation changes, then you don't need to spend all the money. So I think that is still the reason why we're still debating whether that's enough or not. But my own take is that I think whether or not that number is enough is one thing. The policymakers have made it very clear that if this is not enough, more is coming. In fact, the Governor Pan Gongsheng said on the 24th of September, more on the pipeline. The finance minister said something many people didn't notice, but he said the central government has ample room or potential to raise further debt and to increase the deficit. These are words you never heard from MOF minister during the past years. They always say we needed to be prudent, we needed to reserve room for further future action if it's required. But this is time, I think they made it very clear. So my sense is I'm pretty convinced that the policies are aggressive enough to turn around the macro economy. There might be some other issues still around, where, for instance, what the local governments do would be supportive of the policy expansion. And sometimes I actually am thinking they are actually doing the opposite, because the local governments are fiscally constrained at the moment, and some of them cutting the salaries for their own employees, and they're also trying to create some new revenues, which is not very positive for entrepreneur confidence. So these are the things I think we needed to fix. But I'm not worried that the policies have already turned. Now, the vice premier and the three ministers also mentioned the term incremental policy. I had some conversations with investors during the past weeks, and some said to me they were a bit worried because the government was saying incremental policy. That means probably piecemeal, gradual. In Chinese, 增量, incremental actually means additional measures. That means more measures coming. It's not like a very piecemeal or gradual measure. So just want to clarify, this is obviously my interpretation. But whenever they say incremental policies, it really means on top of whatever they have done, they are determined to do more to turn around the economy.
Right, so maybe the translation should not be incremental, it's accretive. I think that's what it meant. Anyways.
I'll make the recommendation.
Earlier, George talked about the +1 strategy, the go global. So I'd like to now turn to Chairman Ge to elaborate a little bit more. And the next little bit is going to be in Mandarin. So I'll give a few seconds for people to put on the headset. 各董事长，那今年来国际的环境变化不断的。Well, this year we've seen a lot of changes.
Now, regional cooperation has evolved significantly in recent years. As a leading bank in China, what are your observations on the go global trend of mainland corporates, and what is your observation on the changing investment strategy, in particular China +1, and what are the opportunities and implications for international financial institutions? Thank you. This is a very good question. Now, for Hong Kong enterprises to go global, this is something that I have been thinking about in the past decade. A lot of changes have happened. If we go back to 2014, our strategy was to attract enterprises to come here. And we encourage direct investment. And since 2014, there had been a major change in relation to foreign direct investments and incoming investment, and that is the outward investment exceeded inward investment. In 2016, another change came in relation to FDI and ODI. They became on a par, according to the latest figures, with a drop in FDI by 10%. China's ODI, that means outward investment, still increased by 8.7%. And that is a significant change. For outward direct investment by Chinese enterprises in the past 5 years, over 70% of that happened in Asia. So we continue to have confidence in Asian markets. And meanwhile, it's apparent that more and more enterprises are investing in Belt and Road countries, ASEAN, as well as Africa. Last year, we recorded a substantial increase in outward direct investment. On the enterprises front, I understand that investment has been diversified to cover manufacturing, professional services, retail, so on and so forth. Now, Chinese enterprises are getting more and more concerned about green and sustainable investment in their ODI efforts. Many enterprises positioned themselves as enterprises that can integrate into the local communities, be it financial institutions in the mainland or overseas. These efforts have brought about a lot of opportunities. Now, more ODI mean that there is a need for more choices of currency for settlement. For FIs in the mainland and in the international arena, there is now a greater demand for the relevant services. And this is where Hong Kong comes in. Hong Kong can play a more pivotal role. It provides a platform in terms of legal, professional services, talents, and enhancing operational capability. Hong Kong is well placed to provide these services. My third point is this. Hong Kong also has a lot of experience in green investment, and I'm sure that there will be good interactions with Chinese enterprises. Let me ask a follow-up question then. We know that the financial services serve the real economy. Now, my question is on the China Plus One strategy. You talked about green transformation, sustainable development. These are the latest directions. This morning, we heard from officials that China's goal is to promote high-quality development. Now, in terms of high-quality development, Mr. Ge, apart from green transformation, can you tell us what are the other areas of concern? And in particular, for FIs and banks in the mainland, what action has been taken to support economic development? And what opportunities and risks are brought onto investors? In the past 30, 20, and 10 years, there have been significant changes. Now, we mentioned the incremental policies bringing about positive development. In the past 5 years, we've been promoting high-quality development, and that entails not only financial services. For the banking sector in the mainland, there have been a significant change in terms of promoting I&T, innovation technology development, as well as inclusive development. In the past 5 years, whilst experiencing moderate economic growth, banks registered more than 10% growth I mean, the support for banks amounted to more than 10%. So the direction for us is to maintain high quality development and drive innovation technology development, especially decarbonization strategies. These are all intertwined. This year, after rolling out incremental policies, we know that there's a change in terms of confidence from international investors and the mainland investors in us. In November, Shanghai, Shenzhen, the transaction volume reached 2 trillion, and that's a sign of confidence. There is also a 13% increase up to $60 trillion in terms of investments, and all in all, there is an 8% growth for sovereign bonds. The 10-year bond yield dropped comparing to that rate in June. The market is recovering, and I know that there is still room for growth and benefits for investors.
Is high quality development. I think maybe we'll stick on the theme of these terms, which sometimes is quite difficult to appreciate once it's translated. So with the new the high quality development, there is also another term that we hear frequently, which is 新质生产力, right? The new quality productive forces. So maybe I should ask Professor Huang to help us understand that better. Now, China's growth rate obviously has seen a significant adjustment, right, from about an average of 7% between 2011 and 2019 to now about 5% in the post-COVID era. It's still an impressive figure, of course, considering that it's the second largest economy in the world. However, what is going to sustain this growth, we heard, is going to be a shift in the economic model and focusing on this quality growth, this 新质生产力, right, the new quality productive forces. Professor Huang, perhaps you can help the audience understand how this transition is progressing and how we should actually look at the opportunities embedded in it.
Well, I think you probably heard the term the middle income trap before, which is not a scientific term, but it basically says many countries can rise from low income to middle income. But most countries would not be able to rise to high income. That's World Bank data shows. For China, I think what we're facing at the moment, our school actually did a joint research with the Brookings Institution, look at the growth outlook for the next 30 years. The key finding was economic condition is already changing. Regardless of the past success, we are entering into a new phase of development, and I can at least summarize 3 key changes. Number one, the low cost advantage is gone now. Income level is much higher. Number two, the population dividend is replaced by rapid aging of the population. And number three, we're still very positive about the globalization, I heard from Bill, which is true to some extent, but the external environment becomes much, much less open and friendly for us. So the question is, how do you continue your growth in this new environment? And I think this is the background of what Bonnie just mentioned, whether you call it high quality development or new productive force productivity and so on. Bottom line is for us economists, bottom line is you need to raise your total factor productivity. You need to remain competitive in this new environment. So I think this is why we're all looking at the new sectors we're pushing. The key question I think it boils down to is, well, can China innovate? When the cost is becoming higher, when the external environment is less friendly, when labor supply could actually be declining over time, The impression, I think, by Westerners on China's national creative capability is very extreme. I give you an example. In September last year, the US Commerce Secretary Raimondo came to Beijing, and she invited Professor Yu Yongding and myself to lunch with her, a small lunch. Her first question was, what is happening in the Chinese economy? Because all the opinion pieces she read in the Western media appeared to suggest that Chinese economy was about to collapse. And then in April this year, we received Janet Yellen, the US Treasury Secretary at our school. Her first point was, your overcapacity in the EVs and other green energy sector is going to eat our lunch. So I guess this is what I'm telling you. Some people say China has no innovative capacity at all. And others say, well, at another time, they say, well, China is going to take all their opportunities of new products. I think the reality is probably somewhere in between. China can innovate, but most of it is still in applied field. Even when we talked about the AI, China is rapidly catching up, but most of them is in application, not original research. So for instance, look at the EVs. The US complaint is about the state subsidy, but if you look at the state subsidy, we have scholars looking at the actual subsidy per unit of EV. China was somewhere in the middle. The highest was Norway, the second was the US, followed by Germany, France, UK, and so on. So state subsidy was an issue, but it's not the key reason why the EV industry expanded very dramatically. I think the local government probably helped in expanding the capacity, but that's another issue. So I think the question now is, can China innovate? My sense is we can. But the problem or the question is, I think we should push to innovate in a large number of industries, not just in 3 areas. So policies still have a room to improve. If you look at, for instance, Michael Porter, a professor from Harvard Business School, he looked at the so-called innovative capacity, and he has a long list of the factors which are very important. These are the factors I think we should look at in China. And the 2 most important factors at the moment, number 1 is we need to keep the country open, because you can't imagine that you can do all innovation by closing the door despite all these geopolitical tensions. Number 2, the dynamism of the private sector, which is vital.
Thank you for that. We do need more different manifestation of the new productive forces. And I really want to carry on this conversation, but unfortunately, the countdown clock is in negative territory right now. So we do have to end this very fascinating, insightful conversation. My thanks to George, Chairman Ge, Professor Huang, and Bill for the very insightful discussion. And I hope we can do this very soon again. And of course, thank you everyone for joining us. I hope you've enjoyed the conversation. Thank you.